This is Scott Becker with the Becker Private Equity Podcast. We're thrilled today to be joined by Matt Wolf. Matt's a leader at RSM and just absolutely brilliant. He talks to us regularly about issues that he's watching in private equity and the trends that he's seeing. Matt, let me tee it up and ask you to take it away. What are you watching currently? What is happening in the world of private equity? Are we ever going to get some rate relief? Are things ever going to start moving in the right direction? What do you see out there?
Yeah, great question. Thanks for having me, Scott. And the context of rate relief, the conversation of rate relief has to come within the context of obviously the Federal Reserve and the state of the U.S. economy. And frankly, the U.S. economy is very resilient. Recently, RSM, as have some others, including Goldman Sachs, we've moved our base case to a soft landing in something that many observers, ourselves included, thought even as recently as a year ago was highly unlikely that we would enter this sort of Goldilocks period where maybe we can just stop increasing rates, let things simmer, potentially start to cut rates a little bit, maybe next year, and avoid any sort of massive unemployment related to taming inflation. And we're seeing that sort of resiliency bet, that soft landing bet in global FX markets with a strong dollar that may continue to attract certain inflows into private equity and certainly into private credit markets as a result, as investors the world over continue to bet on the resiliency of the U.S. economy.
Fantastic. And what do you see in terms of sort of timing of sort of some changes? We see some resilience in the U.S. economy, but is this going to cause the Fed to keep raising rates or just never bring them down? I mean, never is obviously an overstatement. And what are you hearing from the private equity community in terms of deal flow, in terms of financing and the cost of financing? I know things are getting tighter on compliance covenants, on finance covenants. What do you see out there? What are you hearing?
Yeah, it's a great question. I think we expect that we'll probably see a pause in September from the FOMC and unlikely to see additional rate hikes unless some of the hard economic data comes in and tells us otherwise, and potentially begin to see some cuts depending on, again, the hard economic data in the first half of 2024. And that's pretty consistent with a lot of the sponsors and LPs that I've been talking to. I think where there is some disconnect, though, is the frequency and magnitude of any potential rate cuts. It's our view that, again, starting in 2024, the FOMC may look at the hard economic data and suggest, all right, well, we're going to cut a little bit, maybe get that Fed funds rate down from 5.25 to 3.5 or something like that. And I think that there's a large community of investors that expect the FOMC, once rate cuts begin again, to go back closer to zero, which we just see as unlikely. In fact, I don't think we want to be in a scenario where the Fed feels compelled to cut rates back closer to zero, because that means there's some sort of exogenous problem in the economy, right? Perhaps an implosion of commercial real estate or something like that. So I think it's probably safer, and there's more and more investors coming around to this idea that rates are going to be higher for longer. We may see some cuts, and might go down closer to, say, 3.5% next year. But we all got to sort of buckle up and get used to this environment of higher cost of capital, more restrictive financing terms. And the investors that are able to kind of lean into that environment have been able to get deals done, have been able to deploy capital. And we've been seeing a return of some of that deal flow in certain subsectors. And I don't think we're going to get back to 2021, sort of the bacchanal of 2021 deal making. But it will continue to recover as the dust settles on the kind of change in the credit cycle.
Fantastic. And what is deal flow looking like currently? I mean, I would say the professional environment, I see moderately busy, not crazy busy, but moderately busy, because people are really looking at deals, and private equity funds have to be in business. I know with the several funds I'm invested in, capital commitments are coming a little bit slow. Capital calls are coming a little slow, But what are you seeing out there? Is it moderately busy? What do you see?
Yeah, definitely moderately busy, and I would say across most ecosystems and subsectors, it has picked up. Again, we don't expect to see it go back to 2021 levels, but the deal flow is returning. And what's interesting though is just the change in mentality, not only from the sponsors, but also from management teams, from their advisors of, yes, we want to deploy capital. We want to get deals done. We understand that it's possible. We want to put this money to work and we want to do deals, but we're going to take our time. We're going to spend more time on diligence. We're going to spend more time with the purchase agreements, with the LOI, with the board decks and the pitch decks and the whole roadshow process. Like, we are going to spend more time doing this. So it's interesting. Like, so for example, like our due diligence teams are generally full capacity, even though deal flow numbers aren't where they were 2 years ago when they were, well over capacity, right? It's because spending more time being more judicious with each deal that we see, right? Or the investors are from their perspective, and sellers too, right? They want to make sure that we respect the process and go through that. So deal flow coming back, but taking longer, spending more time on it.
Fascinating. Matt, anything else that you wanted to share with listeners today?
Yeah, I think, I mentioned a couple times earlier on, we were talking about looking at the hard data, and Bloomberg came out with a very interesting chart where they sort of dissected the economic data between the hard data, something like the non-farm payrolls report or CPI, versus sort of some of the sentiment kind of household survey type data, and showing that so far this year, that hard economic data has continued to surprise to the upside, continued to come in stronger, better than expected, whereas that sentiment and survey data has come in lower than expected, has continuously surprised to the downside. And I think, today in not only the financial media, but the general media, there's such a focus on that sentiment data. I think a lot of people kind of think of it as maybe a leading indicator of where the economy is going, and it gets a lot of airtime. People spend and focus a lot of time on that sentiment, on that survey data. But if you really disaggregate it and pull it apart, it tells a very different story than the actual hard economic data. And the hard economic data tells the story of a resilient U.S. economy. It provides a better indicator of where we're going. And so I would just encourage everybody listening to really focus on the sort of hard economic data, less on the sentiment data. It's not unimportant, but it may not be that sort of leading indicator of economic performance that a lot of the talking heads in the media would suggest it is.
No, it's fascinating to hear your perspective on it. It's always a more nuanced and intelligent perspective than I get through the general media. Matt Wolf from RSM, thank you so much for joining us again on the Becker Private Equity Podcast. It's always great to visit with you. Again, Matt Wolf, leader at RSM. Thank you very much.
Thank you, sir.